as a point of entry. In other words, as you all know, MACD by definition is moving average, convergence, divergence. And we have the moving average isolated on our chart. So we have MACD below the chart and moving average above our chart. So the combination of these two called indicators will provide us with a well-defined point of entry. As I always say, it's really critical, guys, to be able to use these indicators the right way. You should eliminate stress, fear, and anxiety. In other words, while testing a strategy, you have to be able to, let's say, focus on how to use such an indicators and not exerting pressure at first on yourself to make money. A lot of traders, they make the big mistake of first aiming for the cash, and they thus fail the journey. In other words, they just get in, put two indicators, and start trading on a live account. This is really important, guys. You should first take the indicators, get the feel of it, how they work, understand them, use them on a demo account for a period of time. My approach is, while testing a system, you should use it for a period of 3 to 6 months to get the feel of the system. So how the system operates, how do I identify my point of entry, how do I exit, and all these factors. So it is really important at first to have your day job, yeah? So you do not exert additional pressure on you to make immediate money from Forex. And as soon as you have developed the strategy, you have gone along with it, you have tested it on a demo, you have got the feel of it, then you can actually start trading. And throughout time, once you see that you are generating positive results, then you can consider it as a professional job. So it's really important that what we're going to say today is basically used from a long-term perspective. It can be used by people that they're working on full-time jobs. They do not have the time to be hours and hours over the PC. So this strategy, guys, enables most of the people to trade by checking their charts every so often. So you have noticed that this strategy will be applied on a daily time frame. So we will start immediately with the slides. Just a notification of our today's hosts, Admiral Markets, and their website that you can find really important information upon. And I always start with my favorite slides. On every webinar session, I have two slides I always start with to remind me the reason for trading, to remind me what am I supposed to be doing as a trader. Yeah? So, the very first slide, which most of you have seen so far, is this slide having the football pitch and having the question of how would you score. In other words, this is a very critical question, guys. How would you score? And what do I mean, metaphorically speaking? Let's take things simple. As we all know, a football team, to win a game, they have to score goals on the opponent's net. So every time there is a football game, a team stands greater possibilities or probabilities to win the game by scoring more goals against the opponent's net. So attackers or midfielders or every player from a given team can score from various angles. Yeah? But is it our main objective or vision to score in the Forex market? So, in other words, every time we enter the market, do we really want to make a given number of pips of profit? Is it our main objective to score on a daily basis? Guys, scoring is not valid in the case of Forex. It is valid in the case of soccer or football, but it's not valid when it comes to the Forex market. The vast majority of people aim to score on a daily basis, meaning they aim to make a given number of profitable pips on a day-to-day basis. This exerts additional pressure on them. They become anxious, impatient, yeah, and they start to becoming greedy. So, in other words, to cut the long story short, scoring does not matter at all. What matters in the Forex market, guys, is to have the stamina to stay in the game. The vast majority of people, 95% of them, they start becoming overexcited, especially when they're getting introduced in the world of Forex. And they get in very aggressively. And they try on a daily basis to score a given number of pips. They do not consider Forex as a business. They consider it as a hobby. To succeed, guys, in the Forex market, you have to have a long-term perspective when it comes of winning pips or losing pips. So it's a matter of having the stamina to stay in the game, because the majority of Forex traders, they are able to last within the Forex market for a period of 3 to 6 months. After that, the account balance is gone. So it's absolutely critical and crucial to maintain a long-term stamina. And this is what we're going to see today in today's strategy. You need the discipline and patience to wait for the signals to show you the point of entry. So it's really critical. A lot of people, guys, they just get in, enter into a signal, and that's it. If you miss a signal, wait for the next signal. Do not immediately enter into the market because you fail to see a given signal. Okay. My favorite quotations, guys. Again, these two quotations enlighten me and enable me to understand how should I trade, yes, and what is my overall objective. So, simplicity is the ultimate solution for complexity. A lot of traders, they try to make things complicated. As you all know, guys, nobody can predict the market. What you can predict is your predefined set of criteria you are about to follow every day, day in, day out. Meaning that from day one, you will stick to your predefined strategy without doubting your strategy. And do not try to overcomplicate situations. A lot of traders, they input thousands of indicators, thousands of point of signals. And at the end of the day, they either enter too early the market or they enter too late. And the opposite when it comes to exiting a trade. Because the key, guys, is not your point of entry, but your point of exit. A lot of people, they fail in the way they're exiting a given trade, yes? So we're going to see as well as today, how do we enter a trade using MACD and moving average, and how do we exit a trade using risk and money management, our stop loss, trailing stop distance, or take profit. And Forex trading is all about stamina, long lasting on the Forex pitch. So, step one, keep things simple. Simplicity, guys. Do not over exaggerate on your strategy. And number two, or step number two, maintain a long-term mindset when it comes to profits. Alright, today's agenda, guys, we were going to go through some theoretical matters and then straight away on practical issues. What are indicators? The three types of indicators: MACD with histogram and moving average parameters. So, in the third bullet point, we're going to see what are the settings we're supposed to use while trading such a strategy. And you're going to tell me now, but why are you showing us the settings? It's very simple, guys. 30% of the people will have the patience and discipline to follow the strategy. The remaining 70% of the people will just be impatient and not waiting for the signals. So, even if you give to somebody a Mercedes, let's say, if they do not drive that car as a Mercedes and they drive it, let's say, under a different car, let's say, type of car, obviously you will not have the desirable outcome. So it's how you're going to be using these indicators that will drive you to the next level. Fourth bullet point, placing a buy order during a trend reversal. Placing a buy order within the current trend. So using MACD with histogram and moving average parameters, we're going to see how do we enter on a buy position during a trend reversal, and when do we enter again into a buy position when we are about to follow the current trend. Placing a sell order during a trend reversal and placing a sell order within the current trend. So we're going to see the same exactly issue when it comes in opening selling positions. And finally, your exit strategy, your risk management. A lot of people, guys, what do? They enter using indicators and they exit using indicators. This is a big mistake, guys. Why? Because as we all know, indicators, they lag in time. So we should use indicators, as you're going to see, on a larger time frame with a small settings of parameters. Yeah? And we're going to exit a given trade using risk management. As I said before, our stop loss, take profit, or trailing stop distance, which is the substitute of take profit under a different perspective, which we're going to see in today's session. So I hope that everybody is with me, and let us go to the main spice of today's webinar session. So we're going to go fast on the theory because it's really important first to identify what are indicators, the three types of indicators, so that you understand the reason behind using these indicators. Because if you don't know the reason, guys, you are using the indicators, then it's really important to find that out. Yeah? So we're going to start today's webinar session by first coming to the theory of indicators, so that we are going to have on the background of our mindset the whole understanding and methodology of indicators before we actually move in the practicals of today's session. So let us go fast. So indicators, guys, are used for creating patterns from the chaos of the currency market. Because when you get into the Forex market, as soon as you open your MT4 chart, you can see a price moving up and down. But if you have, let's say, a naked chart, it means nothing. You cannot understand what's going to happen. Yeah? So by involving indicators, it's like minimizing the chaos which appears in your MT4 chart. They're used to give order to the price data so that we can identify possible opportunities. Yeah, so we can identify, in other words, profitable trades. No indicator is right or wrong. Guys, listen to this. It's absolutely critical. No indicator is right or wrong with respect to the signal that it emits, but each of them must be used with an appropriate money management strategy. In other words, your exit signal, guys, your stop loss, your trailing stop distance, your take profit. In other words, it's not your point of entry that will give you profits, but it's as soon as you enter a trade, when do you exit that trade? It's what will give you the desirable results. So we're going to see all this in the upcoming slides when we're going to come to apply point of entry and point of exit. And Obviously, the way different people use indicators leads to different techniques, yeah, which derive to the so-called trading strategy. Okay, and the three types of indicators, guys, and straight away we will move to MACD and moving average. We have three types of indicators. Trend following. So for most traders, guys, it's really important to be able to recognize the direction of the major trend, yeah, so that they can trade with the so-called trend and benefit from profits. Trend confirmation. So it's really important to have, let's say, a signal that will confirm to us that yes, indeed, it's about to enter into a buy position or a sell position. It's about time of entering into a position that we stand greater possibilities of being right. So it's really important to be able to have something that will confirm to us that we are about to enter the right trend direction. And overbought and oversold levels. So today, guys, we're going to be using MACD with histogram to identify overbought and oversold levels, and moving average to identify the trend following and trend confirmation. So these three types of indicators are combined when using MACD with histogram and moving average as a point of entry, which we're going to see in the upcoming slide. So it is really, really important to be able to identify these three types of indicators. Having a way of identifying the trend, confirming the trend, and after all this, being able to identify overbought and oversold levels. Overbought and oversold levels, guys, are really important, especially when it comes in identifying a trend reversal. Alright, so we're going to go through now the parameters of our today's strategy, and then we're going to go to see how to enter into a buy position, a sell position, etc. I hope everybody at the moment is okay. I will proceed and I will answer all your questions at the end of today's webinar session. Alright. Okay, so let us first see the parameters of our strategy. So, strategy parameters. Relative strength index used on a daily chart. Period 7, applied to close, no levels needed. So guys, the majority of traders, they use levels on RSI to identify overbought and oversold levels. In this situation, we do not need the levels. We just need the RSI's main signal line, and you're going to see why while going through the strategy. Then we have the moving average daily, which is period 7, shift 2, apply to close, and method simple. Yeah? Let me see something. Okay, let me correct something. My apologies. Let me do this for a minute. I had the RSI, my big apologies. So, MACD with histogram, guys, 744, and moving average, period 7. Let me do it again, my big apologies. Alright, so MACD with histogram on the daily candlestick bars, period 744. Moving average on a daily candlestick chart again, period 7, shift 2, apply to close and method simple. And let us go straight away on the chart. My apologies before for mentioning RSI. I was going to include RSI as an additional confirmation, but I forgot to change the wording. My big apologies. So, what you can see in here is the moving average and the MACD. All right? And I'm going to send you the slides at the end of today's session. You can see the moving average on the daily chart and the MACD with histogram again on the daily chart. So in this example, guys, we are placing a buy order during a trend reversal. So we are about to enter a trend that is about to reverse towards the opposite direction. So let's see. As you can see, we are expecting that a trend following and confirmation signal when the candlestick bar surpasses higher the moving average to the upside. So in order to confirm that indeed the trend is about to change, we wait for the price to move higher than the moving average. As a second confirmation, we can see that at this stage, the MACD with histogram indicates an oversold level. In other words, to enter into a buy position on a trend reversal, we first want the candlestick or price action to surpass higher the moving average and the MACD showing that we are on an oversold level. At this moment, the price was lower than the moving average, so we do nothing and we wait until we receive the confirmation that the candlestick bar surpassed the moving average and the MACD with histogram indicates that we are in an oversold zone. And we enter into a buy position. Placing a buy order within the current trend. So you can see here that the price has already broken the moving average line to the upside. So we can see the trend following and confirmation signal that indeed the candlestick bar has aggressively surpassed the moving average to the upside. Can you see here now? When it comes in placing a buy order within the current trend, we do not look for overbought or oversold levels. We look for the so-called retracements. So when you can see that the histogram, guys, is very small, it means that it is about to retrace. In association with the candlestick bar surpassing the moving average to the upside, there is a clear confirmation that the upside move is about to continue. So you can see here that the price action, the candlestick bars have surpassed the moving average to the upside, and in the MACD with histogram, we can see the retracement. And when there is a retracement, you can see the histogram bars being very small in their shape. It means that we have a price retracement. The price is about to again retrace to the upside. So this is really, really important. So when you are about to enter into a buy position within the current trend, you first want to see that the candlestick bar surpassed the moving average to the upside, and you can see this small histogram here showing that the price is retracing again to the upside, meaning that you are about to re-enter into a buy position within the current trend. On the other hand, we have the opposite now, placing a sell order during a trend reversal. So you can see that the candlesticks here, guys, confirm the trend following and confirmation signal. And again, you can see here that the MACD with histogram shows that we are about entering into a sell position because we are facing the so-called overbought levels. Buyers have already bought too much of the pair. So you could have entered here, you could have entered here, you could have entered here, anything below the moving average, provided that you can see that in here there is an indication that indeed the pair is facing an overbought level and is about time to decline, entering into a sell position. So when it comes on trend reversals, guys, we consider the so-called overbought levels when we are about to sell on a trend reversal. Yeah? So it's really important in this occasion for the price action, for the candlestick bars to be lower than the moving average, and the MACD with histogram showing that we are already in overbought levels. Placing a sell order with the current trend. So when we're about to enter again a sell order within a given downside trend, we again have to see a confirmation that the candlestick bars are lower than the moving average, and we can see here the small histogram, guys, showing a retracement that the price is again about to fall within the existing downside trend. In other words, we have the price action bars signaling that the price is lower than the moving average, and we have the MACD with histogram showing a small range of histogram bars highlighting a retracement that the price, even if it had tried to escalate, again is about to be forced to the downside. So you have noticed that when we are about to enter within an existing trend, on the MACD with histogram, we consider the small histograms as a retracement. But when it comes on selling or buying on trend reversals, we consider the MACD with histogram when it comes to overbought and oversold levels. Okay, so at the moment, we have gone through buying and selling on trend reversals and existing trends. Now it's about time to see when do we exit a given deal or order, which is the most critical part of today's session. So upon deciding whether to enter into a buy or a sell position using MACD with histogram and moving average, I'm going to show you an example on how to exit. When you are investing using daily charts, it's really important to set your stop loss not far away, but a bit far away, and your trailing stop distance a bit far away. Since I'm mentioning trailing stop distance, I'm going to also explain to you by illustrating you in this slide what do I mean by trailing stop distance. So let's see. Let's assume in this scenario we have decided to enter into a buy position. We have bought at 1.3000 euro dollar. We have placed a stop loss of 100 pips, trailing stop start 200 pips, and trailing stop distance 100 pips. I'm going to explain to you what I mean also by the so-called trailing stop start and trailing stop distance. It's another way of capturing your profits, guys, instead of using the so-called take profit. So let's see. So at this stage, through this slide, you're going to see an example on how to exit a trade. So you're going to be applying the opposite when it comes to selling a pair. This example is just when it comes to buy a pair. The same parameters of stop loss, trailing stop start, and trailing stop distance should be used when selling a pair. So for this example, let's see how we do it. So we bought at 1.3000 euro dollars. We place our stop loss 100 pips lower since we bought at 1.2900, and we activate the so-called trailing stop start at 200 pips, meaning that as soon as the price moves 200 pips in our favor, we activate the so-called trailing stop distance 100 pips below the current updated price and above our point of entry. In other words, we bought at 1.3000, We place our stop loss 100 pips lower at 1.2900. As soon as the price moves 200 pips, the trailing stop start, we immediately activate the so-called trailing stop distance at 1.3100. This means that the initial stop loss we have placed and we have risked, we have converted it now, we have transformed it now into 100 pips of profit. So we have initially locked our first level of profits of 100 pips. Now, if the price moves more and more in our favor, we can lock an additional number of pips of profit, but always keeping 100 pips distance from the current updated price. In other words, we take advantage of the price when it moves in our favor via using trailing stop start and trailing stop distance. So, by the so-called risk management, we apply our exit strategy. Our exit strategy is made up of two criteria: our stop loss and our trailing stop start and trailing stop distance. There are people that they prefer using the take profit. One weakness of take profit is that as soon as you capture a given number of pips, you cannot stay in the deal. Because we are using daily time frames, it's better to use this method when it comes to capture profits so that you can stay longer in a trade and take advantage of greater number of pips. The same implication applies when it comes in selling a given currency pair. So in this example, we have seen how do we exit when we buy. In the alternative scenario, again, stop loss 100 pips, trailing stop start 200 pips, trailing stop distance 100 pips, but doing the other way around because we're going to be having, let's say, a selling position. That's it from me, guys. I hope that you have enjoyed the webinar. I'm going a bit fast so I can answer your questions. So I'm ready to answer your questions. Do you have any questions, guys? Do you want me to repeat something? Was I going a bit fast? Any questions, guys? Did you get the overall idea of the strategy? Do you want me to repeat something? Questions? Shall I repeat the point of entry strategy? How do we enter again using MACD and moving average, or was it clear? This strategy is used for on a long-term perspective, as we said. It was clear, guys. Do you want me to repeat something? We have plenty of time. I was going a bit fast so I can answer your questions, to be honest. Yeah. In my case, guys, I'm only trading euro dollar. Euro dollar, in my opinion, is one of the best pairs, the most volatile ones, and I could say the safer of all, because a lot of people are involved in it. There is a lot of volatile movements, so you can use the MACD with histogram and moving average to enter in such a market, the euro-dollar market, and stand greater probabilities of making profitable deals. So as we said, MACD with histogram and moving average are the two indicators that enable us, let's say, to identify our point of entry so that we get the confidence that we are about to enter a given position, standing greater probabilities of making a profitable deal. Yeah, the shift, guys, it makes the indicator more, how can I say, more fragile. Yeah, because indicators they lag in time. The shift, the more you increase the shift, the more fragile you make the indicator, the more flexible, let's say. How do you enter the first time you get close? Yeah, write your questions, guys, so I will answer them. Do you enter the first time you get a close? Okay, very good question, Ian. Very good question. Let me go again through the slides so that I will explain, I will answer your question, and then I will go to Suman questions. 1 minute. Let me upload the slides again. All right, let me go in this example. In this example here, we wait first. You can see this candlestick bar here. We are not going to enter at this point. We are going to be waiting first, yeah, for the candlestick bar to close, and we will enter at this position. So we have the notification here, this small histogram, that the price is about to retrace within the existing trend. And this histogram here, let's say, comes to quantify the candlestick bar here, but we're not going to enter at this candlestick bar. We're going to be waiting for this candlestick bar to close, and we're going to be entering on the opening of this new bar. So basically, when it comes to enter, in this example, into a buy order within the current trend, and the same obviously applies for a selling order within the current trend, we first wait for a small histogram to appear on the MACD, confirming also that this big candlestick bar has surpassed higher on our moving average, and we enter at this candlestick bar. On the next candlestick bar, we enter into a buy position. But first of all, we wait for the confirmation of the closing of this whole bar above the moving average, and the confirmation prior of this small histogram, which comes to confirm again the closing of this candlestick above the moving average. So we enter on the next candlestick bar into a buy position. Was it clear? Ian, was it clear? Ian? It was clear, right? So the way we enter within the existing trend, we wait for the MACD with histogram to show us a retracement via the small histogram, the candlestick bar surpassing the moving average, and we enter into a buy position or a sell position on the next available candlestick bar. Okay, if the next day the price closes below, would you exit the position? No, guys. You will exit the position based on risk and money management. Based on your stop loss, as we said, 100 pips, trailing stop start 200 pips, and trailing stop distance 100 pips. You exit on those because there might be the case that the price just makes a retracement and is about again to move in your favor. Why exiting your trade and not remaining in your trade to get more number of pips, additional number of pips? That is why you're using point of entry via the MACD with histogram and moving average, and your exit is clearly through risk and money management, stop loss, trailing stop start, and trailing stop distance. Do you apply MACD trades with support and resistance levels and trend lines also? Yes, guys. I mean, there is not the perfect combination. Some people are using MACD with support and resistance levels. What you need, guys, is a confirmation signal. Yeah, you're looking for that confirmation signal that will enlighten your psychology, let's say, and will make you more self-reliant to enter a trade. So we use, in this case, MACD with histogram and moving average to increase our confidence level that we are about to enter the right direction. But when it comes to exit a trade, as I said before, we use risk and money management parameters. Because let's say you have entered into a buy position based on this criteria, and you remain within your buy position, and the price, let's say, comes a bit lower than the moving average, and you exit, and then the price again goes high and higher again. It means that you have closed your deal and you have missed the opportunity of generating more and more pips. By using the trailing stop start and trailing stop distance, you stand greater chances of acquiring greater amount of pips, greater number of pips when a trend moves in your favor. That is why we use indicators for point of entry and risk and money management for point of exit. Do not use indicators as a point of exit. Use them, guys, only as a point of entry. Yeah? Did you get that, Brit? Right? I hope I said your name right. Did you get, so you can use MACD and a combination of other indicators. But you should predefine how you will be applying these indicators. So in today's session, we have seen that how do we apply MACD with histogram and moving average when it comes to buy or sell on trend reversals or within the existing trends. Because the key here, guys, is what? To be able to identify when a trend is about to reverse and to be able to identify when a trend is going to continue moving within the current direction. Excellent, Brit, right? Excellent. If you're using trailing stop for trade exits, it's fantastic. Excellent, fantastic. Because, guys, using trailing stop, it gives you the opportunity to capture more and more pips because trailing stop runs behind the price. So as soon as the price moves more and more in your favor, the trailing stop starts running behind the price. That is why it's really important to first identify your point of entry through the use of indicator, let's say, and use risk and money management as your point of exit. Do you want me to repeat something again on the indicators? Shall I go through them by the slides? Do you let trades run? Yeah, guys, I mean, it's a matter of sticking to your strategy. The vast majority of people, they do not stick to their strategy. Yeah? So, if let's say I am in an already existing position and I have applied my trailing stop start and trailing stop distance and I'm still within the position, yes, I'll stay within my position over the weekend. It does not matter whether there is a weekend or not. In case there is a market gap on Monday, let's say, and you are in a winning position of 100 pips, you will win 60 pips, let's say, due to a market gap, or 50 pips. What matters, guys, is that you have applied your strategy with discipline, and even if you have acquired a less amount of pips because you have stayed in over the weekend. So the big issue is implementing your strategy from day one, following your rules from day one. So if your indicator tells you that it's about time to enter on a trend reversal, enter. If your indicator tells you that it's about to enter within the existing trend, enter within the existing trend. Use your stop loss. Use your trailing stop start and distance, and afraid of no one, guys. Stick to your strategy. Yeah? The key to success, guys, it's what? It's actually how you follow your strategy. The vast majority of people, they fail to follow their strategy. So today we have seen how to enter, let's say, on trend reversals, an existing trend. But if you start trading and you fail to oblige to these regulations, to these signals, obviously you're not going to be successful at the end of the day because you haven't followed your predefined set of criteria. That is why 95% of the traders, guys, they fail to follow their predefined set of criteria. They do not oblige to their initial criteria. And it's a fact. In the Forex market, you're going to be facing some consecutive losses as well. It's during those times that you have to stick to your predefined strategy. and not letting go of your strategy. The vast majority of people, they start trading, they're winning the first week, the second week, the third week. When they have a fourth losing week, they immediately blame their strategy and they start changing strategies. They start changing their stop loss, they start changing their take profits, they start changing their buying and selling signals. No, guys, this is a big mistake. Change nothing. Stick to your predefined set of criteria. If we see that MACD with histogram, moving average says enter, we enter. And immediately we apply our stop loss. 100 pips, trailing stop start. 200 pips, trailing stop distance, 100 pips. If you apply this over and over again, you cannot fail in the long term. The vast majority of people, guys, they are willing to win in the short term, but fail in the long term. The vast majority of people, they cannot go through the short-term pain for long-term gain. It's really important, guys. The vast majority of people, they fail because they lack the discipline of following their initial strategy from day one. Even if you have 5 consecutive losses in a row, even if you have 10 consecutive losses in a row, you should still apply the same strategy. It's the repetition of your strategy that will drive you to the next level, and not your actual strategy. 5% of the traders are successful, guys, because they do not doubt their strategy. So let's say today I have showed you this way of entering the market. MACD with histogram and moving average. If you apply this methodology over and over again, you simply cannot fail in the long term. You might be facing some short-term losses, but it's part of the market. If you do not accept within you guys that the Forex market will provide you also losses, it's really scary and very stressful. So you have to accept the fact that you will apply your predefined strategy, your predefined set of criteria. You will be applying your point of entry by the use of these indicators or any indicators you wish to follow, because there is not a right, not a wrong way of using indicators, guys, provided that you will use them with consistency and you will not doubt your signals. Another person might be using MACD 1553. Another person might be using MACD 2010-2. It's not the point of entry that matters. It's how consistent you apply those settings. So to be successful in the Forex market and to be part of those 5% of the successful traders, you have to apply your criteria from day one without doubting your strategy. And the same implies for your exit criteria. You have predefined that your stop loss will be 100 pips. Let it be 100 pips. Do not change it when you are facing a consecutive number of losses or a losing week. Because by changing your exit criteria as well, you are changing your whole strategy. It's like you are starting from the very beginning again. You are going through the so-called beginner cycle. So, to be part of those 5% of successful traders, use a predefined set of criteria from scratch, apply them on a demo account first to get the feel of it, yes? And then, guys, the market is always going to be here. The market will always be ready to offer you both good times and bad times. If you are willing to face short-term bad times, then for sure you're going to be facing long-term good times. So the most critical part in the Forex market is the repetition of your strategy. So in today's session, we have seen how to enter into buy and sell positions. You wish to follow these signals, follow them without doubt. Use them over and over and over again. And the exit strategy, the same exit criteria over and over again. The repetition is what will drive you to the next level, because the successful traders, what makes them successful is the repetition of their strategy from day one. The most successful forex trader, guys, Bill Eckhart, a person that he was trading since 1975. As soon as he started trading, he had a drawdown of 60% from his current balance. Everybody doubted him. What this guy is doing, he has no clue what he's doing. But he became the most successful trader of live traders. Why? Because even when he was losing 60% of his current balance, he was still doing the same thing. He was still applying the same entry criteria, the same exit criteria, the same psychology. Yeah? So, the most important thing in the forex market is being able to repeat your predefined strategy forever and ever. So this is important, guys. It's the repetition of your strategy that will define you as a successful forex trader. Because in the forex market, what you can actually do, guys, you cannot control how many pips you're about to win. What you can control is how many pips or the number of pips you are willing to risk or lose through your stop loss. So, once you are able to adjust within your mindset that you're going to become a manager of bad trades at first and then a successful forex trader, then you are halfway through success. Because by doing so, you accept the fact that there are going to be tough times as well, but if you apply your strategy with discipline and patience and your point of entry and exit criteria, you cannot fail in the long term. So, keep things simple. What you have seen today, it's very simple, guys. I can send you the slides as well. But it's really important to remind you, because I had a problem these days with my email. This is my email. You can forward me your emails and I can send you today's slides on your emails. I hope that I was able to provide you the feeling of the forex market. And I hope that the strategy was of a good use to you. A strategy to be successful, guys, as we said, depends that you stick to the rules. Stick to the regulations of your strategy. Most of the successful hedge funds, they have people that they pay to follow their strategies. Yeah? Indeed, Ian, day chart trading, guys, saves you from a lot of trouble of false signals, a big noise which takes place within shorter time frames. Day chart trading enables you to work at your day job and just check your computer every so often, once a day, if you see a signal to enter into a position. It avoids all the stress of being constantly on your PC, trying to scalp and do things like that. Scalping worked for no one, guys. The successful traders were the ones that they were applying day chart trading. And thank you, Ian, for mentioning this. The most successful traders, guys, they trade in the long term. They aim for long-term profits. So they use daily charts to avoid all the noise, all the false signals which shorter time frames provide them. And they just wait. They just wait, guys. You know, waiting is another key to success. Yes? You have to wait for the signal. So, you just wait 1 day, 2 days, 3 days, 4 days. If you have no signal, guys, you will not trade. Why trading and losing your psychology, exerting pressure on yourself? So, having your day job, checking at work once or twice your charts on the daily chart, seeing, there is no opportunity, I will not trade today. Tomorrow, there is opportunity, I will trade. Place your stop loss, Wait for the price to move in your favor. Place your trailing stop start distance. Try to keep things simple. Do not listen to people that they tell you you have to be constantly on your computer. Doing what, guys? Getting overstressed? No. A successful trader is a trader that he or she is relaxed, waits for the signals, clear confirmations, follows rules and regulations, follows entry and exit signals. So as you have seen in today's strategy, we have used MACD and moving average in deciding when to enter into a buy or a sell position during a trend reversal or within the existing trend. If you have the patience to wait for these signals, then you will succeed, because the vast majority of traders, they do not have the patience, guys. They cannot wait. It's like they are in a constant hurry. It's like somebody is running after them. Why? You do not need to prove anything to no one. Yeah? Because a lot of traders, they trade to say to their friends, today I've made 50 pips. Today I've made 100 pips. Well, after 2 weeks, you will lose everything. This is the hard truth, because you are acting aggressively on the market. So, through day chart trading, through using indicators or long-term time frames, you avoid this overexcitement. You avoid this stress. You keep calm and wait. You become a discipline by nature. Yes? So guys, I hope I was able to elaborate and communicate to you my ideas. Sometimes I get overexcited, but I'm a trader as well, so I want to share my views and ideas with you. I would like to thank you for being with me in today's webinar session. I would like to thank all of you guys for staying with me for this 1 hour. Indeed, Ian, indeed. Enthusiasm. I have a quote, guys, before we close. 3 quotes, actually. Time is your best friend in the Forex market. Do not underestimate the market or overestimate your potentials. Overestimate your passion and underestimate your fear. So, always be passionate about it, guys. Yes? Keeping a low profile. Do not over-exaggerate. Follow your system. Always be disciplined. Always be patient. And let long-term results trigger your success. Special thanks to everyone. Special thanks to Ben, investing.com. Special thanks to admiralmarkets.com. And great thanks to all of you guys for being with me for this 1 hour. Wishing you a great remaining of the day. Wishing you a great rest. See you all in the upcoming webinar session in 2 days from now. Bye-bye.